Hey everyone, welcome to the show. My name is Sam Shaw and I'm the founder of Wall Street Mastermind. This is Wall Street Mastermind's Elevate program, where we take our flagship coaching program and give it away for free to high potential students who are currently in a difficult financial situation. The goal of this show is to first and foremost give these students the coaching and guidance that they wouldn't be able to get otherwise and help them break into investment banking. Of course, we also want to give all of you an in-depth look at how to go about your own investment banking preparation process the right way, so that you can model it after the same proven methodology and strategies that we've used to place over 90% of our students into investment banking across every single bulge bracket and elite boutique bank over the last several years. With hundreds of thousands of applicants competing to break into investment banking globally each year, our team only has the bandwidth to help a very small percentage of you. So my hope is that this show helps all of you, even if you aren't able to directly participate in our program and work with us. So let's get to it. In this session, we finally have some good news for Ximena. She was accepted into Citi's Early ID program, bouncing back in a big way from her previous setbacks with her other bulge bracket bank interviews. We then do some technical prep, covering questions across a variety of topics, including the three statements, LBOs, DCFs, and accretion dilution.
Hey, Ximena. Can you hear me? You're on mute.
Hello.
Hey, how's it going?
Good. How are you?
Well, it's just got off office hours. Man, that was pretty cool. Were you on office hours? No, you weren't.
No,
right?
I was gonna go, but I thought we were meeting in the middle of it. I thought Edgar was gonna do it, but I reached out to him.
Yeah, no, it's fine. We're gonna share the recording inside the module. It's super cool. Like he built this thing. He built this thing where it basically like just automates all the email sending and stuff. And so he sent like 500 emails in like, I want to say like 10 minutes, not 10 minutes. Like it took him 10 minutes, but I think it sent over like within like 1 hour, one hour time frame. And then he said he got like 30 responses right away. And he has like 15 calls set up for next week, which is like, that's like a game changer because you'll never run out of calls basically, right? And it just saves so much time. It's just crazy.
Yeah, I reached out to him and I was like, I do this one by one, so I really need this.
Yeah. No, so I'm excited. Like we're gonna upload it into the module as a training for everyone, and then it's a little bit technical, but like it's not that hard. We're trying to build like really detailed instructions so that people can kind of follow it step by step, and then it should save people, I don't know, dozens of hours, if not more, maybe hundreds of hours. So yeah, that was cool stuff. That was like highlight of my day. Kind of nerdy, but it's okay. Anyway, what's going on with you?
With me, I think it's good. It's going good. Past few weeks, so I joined EarlyID for Citi. I've been doing that a couple of weeks, just meeting with somebody from Citi kind of on a week-to-week basis. That's a mentor, and then they're kind of prepping us for an interview. Eventually, if they think we did the program well, we get to have an interview at the end of the process. So we go through a mock interview next week, I think, and then from there they would push us. Okay. So that's for Citi.
That's awesome. How do they determine if you did well? Like, what are they doing with you?
They're just talking to us every week. So at the first, it was like just an introduction, like, why are you interested in investment banking? Just kind of getting to know each other. And then they kind of tell you about like the recruiting process from like the general meetings. They would tell us that sometimes you get homework. So like maybe whoever you have, your mentor will send you to do some things. I haven't really gotten a lot of homework, but just kind of like look into the business, look into things that you're interested in. And then this week we're going over like the elevator pitch. So he's supposed to give me feedback on that. And then next week you do a mock. So I think it's like they're kind of filtering, like they get to basically choose whether you are like ready to go to an actual interview. So they're kind of that filter.
Yeah. And how long is this program? It's like a month, 2 months?
6 weeks.
6 weeks. Okay. And then like at the end, if you do well, then the interview you get is for junior summer, for summer 20.
Yeah.
Okay. That's awesome. And it's going well so far? You feel like you and your mentor, like you guys get along?
Yeah, he's cool. He's nice. He's really nice. I've networked a ton with other people in a different team. So that's the one where like the MD reached out to me really randomly, but it's been really cool because they had me network with a lot of different people. And I think they thought I would get paired with like an MD or a VP, but I think this year they're pairing us with analysts and associates. So he reached out when he knew that I got into the program. He was like, "Hey, just so you know, like give me a call whenever you want," because he was the one that had initially reached out. So that was really nice.
The MD that helped you get into the program. I mean,
Yeah, yeah.
did you connect with him yet? I remember you telling me about that.
Yeah, so he reached out to me on LinkedIn. He referred me to talk to somebody, and I basically talked to him for a few weeks. And he was having me, so the MD wanted me to keep talking around to other people in the group. So I talked to another VP and another analyst at a city in another office. And so that those went pretty well. So then at the end of the day, at the end, it came back to the person I initially talked to, but I'd never talked to this MD before. So the next time I talked to him was when he reached out. He was like, "We're so excited to have you in the program." So it's been cool. I haven't met him, but he's done a lot. So it's been nice.
Yeah, you should definitely meet up with them, and I mean, you don't want them to feel like you, not that you are, but that you're like ungrateful or whatever, you know. So like,
Yeah.
I just like reach out and set something up. But that's cool. That's awesome. So it sounds like that's going well. And then what else? Any other notable updates?
No, nothing much else. I don't know how if it's competitive at all. There's Morgan Stanley has an early insights, but they sent out an email today for you to apply like what office
Yeah,
you would want to go in. So I think that's just going to be a general event.
yeah.
And no, nothing else.
Didn't I thought you got did you get selected for something else too? Or was that the Citi Early Insight thing or Early ID thing? I might have gotten mixed up.
I think so. That's what I got selected for.
Oh, got it. Okay. Got it. Oh yeah, that's right. No, I'm reading our conversation now. This is the one. Okay. No, that's awesome. Um, cool. So then you just been networking. Have you submitted any applications yet, or you're kind of still waiting, or?
Yeah, I did. I did. I've submitted basically all the applications. What I haven't done, which I need to do, is kind of reach out to some of the people I network to let them know I submitted my application, which I think is kind of what does it. But I definitely wanted to go through a bit of some technical work and things like that, just kind of get your feedback on how I'm wording things. And so I've just, my cold feet have been just reaching out to people and telling them, like, hey, I submitted this and this. But I do have a few contacts in quite a few places. So just waiting on that. And then we'll see how that goes.
Okay, so you've applied to all the places that have open, so that's like it's got to be like at least 20 apps, right? There's
The
like,
majority, some of them I haven't. I didn't want to make it too big, but I have, and I've continued. I'm still waiting for like a few that will open in March, but I've applied to the majority.
okay, all right, cool. Okay, so you want to do some technical work, right? You want to just do like a technical mock or and like kind of see how you do? Is that the best way to go about it, or what would be most helpful?
Yeah, I think I just want to just yeah get my feet wet kind of with some technicals just in general. I'm pretty done with everything. There's some like special modules that are like I had it noted down that I needed to go over. It's the like NOL, DTA, DTL. I'm not too sure what that is yet. And then that is pretty much it. And then just memorizing the covenants and things like that. I have everything written down, but that I'm not sure yet. But I don't know. The rest maybe just kind of go over everything. We haven't really done a technical in a really long time. So
Yeah. Okay. Do that. Is there like a particular part of the technical that you feel like you need more, whatever, more help in, or like more of a check to see if you're on the right track? Like, I mean, accounting, valuation, M&A, LBOs, like maybe is there anything that is like, oh, I'm really good on this part, I don't need any help there, but I want to mostly focus on this, or you want to just like do a little bit of everything?
I think I might want to do a little bit of everything. I think maybe with an emphasis, I do want to see how I'm wording the DCF module and like the valuations, which is pretty basic, but I think just the wording of it. I think one of the things I've noticed is like it's really important to just kind of get the idea across and not rant into it. I feel like I try to like explain it in my head and then I rant away. So
Okay, for sure. Let's dive into it then. I'll just try to get through as many of these as we can, and I'll give you feedback along the way. Okay.
Okay.
All right. Let's start with some accounting stuff. So let's say there's a company, they buy a factory for $100 using debt. Okay. So can you walk through just like what happens initially on the three statements? It's like in year zero when they buy the factory, like what happens?
Yeah. So year zero, the first thing, so nothing happens on the income statement. Initially debt would go up on cash flow from financing activities. So cash flow would go down by 100 since you're taking out a loan. So at the bottom of your cash flow statement, you would have negative 100. That would flow to the top of your balance sheet since cash is the first item. So you would have a negative 100, and then liabilities would go, oh, yeah. So you would have, so cash flow, wait, sorry. Okay. So if you're taking out debt, then so cash flow would go up by 100, and then that flows to the top of the balance sheet. And then you would have plus 100 on the top of your balance sheet. And then your liabilities also go up since you took out debt. So those two would balance. So your balance sheet would balance.
Okay.
So then, right?
Okay. Keep going.
Okay. And then so then you go to buy equipment with it. So so then that's when you go back. So again, it's not since it's PP&E, nothing happens on the income statement. So going into the cash flow statement, cash flow would go down by 100. So then that would, sorry. Okay. I think I'm just nervous. I just need to breathe. Capex. Okay. Sorry. Yeah. So nothing happens on the income statement, and then Capex would go up by 100. And then from financing activities, cash would go down by 100. So that would net out in 0.
Cash flow from financing goes down by 100, you said?
I think, sorry, I've gone over this so many times. Hold on. Capex,
Yeah. Okay, start there. So no change on the income statement.
no change on the income statement. So then you capitalize it because it has a useful life of more than a year. So Capex goes up by 100, and then, but you're paying for it. So wouldn't from financing activities go down by 100? No.
Well, so CapEx, if you say CapEx goes up by 100, is that a
Yeah.
positive cash flow or negative cash flow?
Negative cash flow. Yes. Okay. So so you capitalize it. Sorry. Okay. You capitalize it. So that's a negative 100. So your cash flow ends at negative 100. And then that flows to the top of your balance sheet. So you have a negative 100 in cash. And then PP&E also goes up by 100. So then that balances your assets and your balance sheet would balance.
Okay.
So that would be the first year, nothing happens on the income statement.
Right. Okay. So well, that's year zero. It was like first year had passed it. It's just at the time of transaction, right? So okay, so like I mean you got to the answer, but obviously that was very, very messy. So you have to, right. Okay, so then let's say now 1 year passes. Okay. Walk me through what happens to the financial statements in the first year.
Okay, so I would need to know what is the useful life of the equipment.
Yeah, let's say it's 10 years.
So if it's 10 years and if it was 100, so using straight line depreciation, it would depreciate by 10 every year. What would be the tax?
For the tax rate, let's say it's 40%.
40%. So on the income statement, depreciation would make expenses go down by 10. So you would go down by 10. So expenses would go up. So then your operating income would go down by 10. And then applying a 40% tax rate, that would be overall income would go down by, you would save four on your taxes. So overall income would go down by -6.
Is there anything else? Any other expense that you need to take into account?
Yes. So the debt, is there any interest expense on the debt?
No, there's always interest expense.
Yes.
You never
What is the interest expense on the debt?
10%.
10%. So after operating, it's okay. Can I start over?
Yeah.
Okay. So depreciation would go down by 10. And then, so that would be, so operating income would be at -10. And then if interest expense is 10%, then that would be -20. You would be at -20. And then applying a 40%, a 40% tax, then you would be at, you would save 8 on your taxes. So then you would be at a -12, and then that would flow to the top of your cash flow statement. So you would have a -12, and then any changes from working, so you would add back depreciation. So then you would be at a +10 with that. So now you're at a -2. And then going down the cash flow statement, nothing else happens. So you on the bottom of your cash flow statement is at -2, and then that flows to the top of your balance sheet. And then PP&E will also have to go down by 10. So then your assets are at -12. And then finally, your net income, which was at -12, would flow into shareholders' equity. So both sides would balance at -12.
Sorry, I was on mute. Okay, that sounds good. Let's say, okay, I think that's fine. I mean, I think, look, like on the accounting stuff, I feel like you get it. You're also using the right framework. You're going through the statements in the right order, and you are also, like, you understand what the line items are, but I think it's just like practicing more and being smoother with it, and like not missing like silly little things, right? Or like, not like forgetting to ask about interest expense, and then like,
Yeah.
what else is there? And then you're like, oh yeah, there's interest expense, right? Or like, don't ask like, is there interest on the debt? Like, there's always interest on the debt, right? Like little things like that. But I think like those are easy fixes, right?
Yeah.
Okay. Let's see. Okay, let's do some valuation stuff. So, can you talk about if I ask you like, what are the 4 main valuation methodologies? And then I also ask you to rank them from the highest valuation to the lowest valuation, like what would you say?
So for the 4 main valuation methodologies, I would say, so you have trading comps, trading comparables, you have transaction comps, then you have DCFs, and you could use a LBO for the 4th one. So I would say ranking them, the first one would be the precedent transaction, because normally you're using a premium when you're looking at transactions as they were valued in the past. So usually that premium will push how much the enterprise value was. Next, I would say would probably maybe
Push how much the enterprise value is.
would increase how much the enterprise value is.
Okay.
And then I would say next would be the DCF, because normally since you're projecting cash flows into the future, you're normally projecting a growth of the company. So that would probably give you a higher valuation than what it currently is. And then I would maybe an LBO. And well, third would be the trading comp, since it's a day-to-day, you're looking at the current share price of other companies, and that's how you're determining the trading multiple. So since it's a current valuation, it would probably give you the lowest valuation out of those 3. And then an LBO, I guess, I don't know where I would position an LBO, I guess between precedent transactions and trading comps, since normally you're also projecting cash flows into the future, and you're normally targeting like a 20 to 25% IRR. So that's normally you're looking for a higher valuation, because technically the return you get is based on having a higher valuation in the end. So you generally kind of want to trade with a higher multiple by the time you exit. So I think LBO would be after precedent transactions. So in order, it'd be precedent transactions and LBO, then trading comps, and then a DCF.
Okay. Some of the stuff is like partially correct, some of it is not. So what I would typically say is typically present transactions are going to give you a higher valuation than your trading comps. Okay, because obviously present transactions take the control premium into account, trading comps don't, right?
Mhm.
But a caveat here is that like the recency of the present transactions that you choose matters, right? Because like we've been seeing that in the last couple of years where sometimes we get public comps that actually give a higher valuation than precedent transactions because the stock market's been going up for so long. I mean, not like in the last 2 months, but like, for like most of 2021, stock market just kept going up. That means the publicly traded companies keep trading at higher and higher multiples to the point where like their multiples are now actually higher than some of the M&A transactions that happened like several years ago, right? And so it's kind of like wonky, right? But typically in a normal market, if you're comparing recent precedent transactions to current trading comps, then the precedent transactions should, in theory, have a higher valuation. So that's the first thing that I would say, right?
Mhm.
Does that part make sense?
Yep.
Second thing is, I think you said DCF was second highest. DCF is actually like a wild card. It's an unknown variable because it can be as high as you want it to be or as low as you want it to be, depending on like who's doing the DCF, right? I think what they're testing you on here is like, do you understand that there's a lot of different assumptions you can change in the DCF? Like if I increase the revenue growth rate, DCF is going to give me a higher number. If I increase the margins, DCF is going to give me a higher number. If I lower the Capex, DCF is going to give me a higher number. If I lower the WACC, DCF is going to give me a higher number. I can also do the opposite on all of those things, and DCF is going to give me a lower number, right? So like what actually happens in real life is like if there is a transaction and there's like Goldman Sachs is advising the buyer and then like Morgan Stanley is advising the seller, Goldman Sachs will always use like more conservative estimates when they're doing the DCF because they're advising the buyer. The buyer is not going to take everything on face value. The buyer is going to like discount the management team's forecast and say like management team's probably overly optimistic. Like we're going to be more conservative. We're going to assume like revenue is going to be a little bit lower than what they said. Margin's probably going to be a little bit lower than what they said. Capex probably going to be a little bit higher than what they said. Like, so like they're going to come up with an enterprise value that's lower and a per share price that's lower, right? But like the Morgan Stanley that's advising the seller, they're trying to get the highest price possible for their client. So they're going to like give the most rosy, the most optimistic assumptions in their forecast. Like, yeah, like we're going to grow like gangbusters and like our margin is expanding because like our cost structure is like getting better and better as we scale. And like, we barely need to spend anything on CapEx because we have so much excess capacity already. Like, you can say whatever you want and try to justify or like defend your assumptions. Like they're going to come up with like two totally different numbers. And then like, part of the whether the deal goes through or not is like, can they agree on something in the middle that kind of like is reasonable for both sides, right? So like, I wouldn't say all that in an interview. That's just me explaining it to you. But like in an interview, I would just say like, yeah, like DCF is a wild card. Depending on like how aggressive you are with the assumptions or how conservative you are, you can get a much higher valuation or a much lower valuation. Like you can almost make it say whatever you want, right? So that's the second point. And then the last point on the LBO, what I would say is like the LBO is typically going to give you what's called like the floor valuation. What does that mean? It means that like if you use the LBO, if you run an LBO model on a company to try to come up with the valuation, you're basically saying like, hey, how much would a private equity firm be willing to pay for this company? Because whatever the private equity firm is willing to pay, that's another data point on what this company is potentially worth, right? And the way the LBO model works though is that PE firms are trying to figure out like what is the maximum price they can pay to still hit the minimum IRR requirements, right? Like most PE firms, like they say, we won't do a deal if the IRR is lower than 20%, right? So one of the levers or one of the drivers for IRR or for the return on the deal is like, how much do you have to pay for it in the first place, right? The more you're paying up front, the lower your return is going to be, right? It's like buying stocks. Like the cheaper you buy in at, the higher your return is going to be. The more you have to pay for the stock, the lower it's going to be. The same thing for LBO, like the higher the valuation, the lower the IRR. So the reason why it's called a floor valuation is because if we say like at a minimum we want to hit 20% IRR, that means that there is a ceiling like the valuation that can actually be paid. Like beyond that price, if they pay even more, it won't be possible to hit 20% anymore. Then it'll drop down to like 19 or 18 or 15 or whatever. Right. So it's almost like the LBO almost puts like a cap on like, oh, this is the most that a private equity firm would pay. So like usually it's going to give you a slightly lower valuation. Right. There's another like follow-up question to this one, which can be like kind of a trick question. Is like, really? But like an LBO is like an M&A deal, right? So like if it's an M&A deal, like they should be paying a premium for the company. So like, shouldn't it be just like similar reason to why precedent transactions would be higher than public comps? Like shouldn't LBOs also be higher than public comps because it's got this control premium baked in, right?
Yeah.
So that could be a tricky question. So like, I think the distinction there is like, if you're talking about using an LBO in the context of like just as a valuation tool, then you're not saying like this LBO deal already happened. So like the control premium has already been paid, right? You're saying if a PE firm were to look at this company today and try to value it, like what is the maximum price they would be willing to pay? So there's a difference, right? Because a private equity firm might do like LBO models on like 10 different companies, and maybe only one or two of them will hit like the IRR threshold requirement. And then like the other 8, they'll just be like, yeah, we can't pay enough to make this deal, to make the IRR high enough. So we're just not going to do this deal. So like most deals don't happen. Does that make sense? So like, obviously like if the deal did already happen, then yes, I would agree. Like they probably did have to pay a premium for that company, and that should theoretically be higher than what you would be getting just from looking at public comps. And then probably in that instance, like lower than what you would get on precedent transactions still. You know why the LBO would still be lower than precedent transactions?
Because
kind of nuanced too, but if you get this, then that's pretty good.
Wait, why the LBO would be lower than precedent transactions?
Yeah, I'll tell you the answer. Is because precedent transactions is just like a list of all the M&A transactions that have happened in the space, right? So it could have both PE transactions, and it could also have transactions where the buyers are strategics, right? Strategic buyers.
Right.
And what's the difference between strategic buyers and PE buyers?
So PE buyers are going to exit, right?
That's not what I was getting at. But like, if I ask you like, who could typically pay more, a strategic or a PE firm? Who?
A strategic.
Yeah, why is that?
Because there's more that they can do with the company into the future. Like they can work on revenue synergies. Like there's more that they can give to the company than a PE firm that will likely not have as much or will have to exit eventually.
No, it's not quite how I would explain it. It's not because they have to exit the company. It's because it's what you said, that was synergies. So synergies only happen when two companies combine with each other, right? Because like, what is synergy? Synergy is like revenue synergies or cost synergies, right? Cost synergies is like, hey, we have like redundant headcount. We have like 2 HR departments, 2 finance departments, 2 sales departments, 2 marketing departments, and we don't need 2 of everything. So we're going to keep the revenue from both sides, but we're going to cut like a bunch of the headcount. We're only going to keep the teams from like this side of the company, or we'll keep the team from this side, we'll keep like half of each side, whatever. But like now you shipped out like, a portion of the cost structure that like used to be there is no longer there. That's cost synergies, right? Revenue synergies is like if the 2 products that they offer are like complementary, or like when you sell them together, it becomes an even more attractive offer. You can like bundle it, you can cross sell to each other customers, you can upsell, you can whatever. There's a lot of things you can do, or maybe like you got more pricing power because you acquired one of your biggest competitors, and now you don't have to like get into like a price war with them where you guys are both trying to discount your stuff to beat each other out. Like that could be a revenue synergy, right? But like that only happens if it's like a company acquiring a company. If it's like a PE firm, acquiring a company,
Mhm.
you don't have those benefits,
Mhm.
right? Because the PE firm is just like the owners of that company. They're not combining that company with another entity where there's like all these synergies that can be created, right? There's
Mhm.
definitely no cost synergies because you're not like getting to cut any costs. There's no cost to cut. And then like revenue synergy is not like the PE firms, I mean, they don't have a product or whatever that you can offer together, right?
Right.
Does that make sense?
Yep.
So if someone asks you like, hey, who can offer a higher valuation, strategics or PE firms? Is always strategics, and there's like they
Mhm.
ask why. It's like, oh, because strategics benefit from synergies, and PE firms don't, which means that strategics can offer to pay more for the exact same asset because that asset is worth more to them than it would be for the PE firm. Does that make sense?
Mhm. Yeah.
So like I just asked this question like a different way. I just said like, hey, would LBO give you a lower valuation? Or why would an LBO give a lower valuation than precedent transactions? Was because precedent transactions includes both strategic transactions and PE transactions, and the strategic transactions typically have a higher valuation, right?
Mhm.
Versus LBOs, like it's only the PE firms, and so it doesn't have the benefit of the synergies.
Okay.
Does that make sense?
Yeah.
Okay. I know I went through that pretty fast, but I think you got it. Okay, so we talked about DCF, right? So like when you do the DCF, I guess first of all, like walk me through how you would do a DCF, like at a high level. Like I mean, I don't need all the nitty gritty details, but like at a high level, like how does a DCF work?
So normally you take the company's financials and you project them 5 to 10 years into the future using assumptions on revenue growth, um, um, growth margins, or working capital. So you project them 5 to 10 years into the future, and then you have to discount it back to take into account the time value of money to the net present value. And then you also have to calculate the terminal value, which you can using a terminal multiple or the Gordon growth method. And then you also discount that back to the net present value, and then you add those two together to get the enterprise value.
Okay. So when you're projecting out free cash flow to discount that back, what kind of free cash flow is that? Is that like levered or unlevered? Like what are you supposed to use?
It can be levered or unlevered. It depends the what you're trying to get at the end. So if you're using unlevered and you discount that back, you would discount that back using WACC and you would get to the enterprise value. Whereas if you were using levered free cash flow, you're you're already paying back the debt holders. So when you discount that back, you're using the cost of equity and you're getting to equity value.
Got it. Okay. And you say you discount it back against the WACC. Like explain this concept of what WACC means to me.
So WACC is the cost, the returns that equity investors and debt investors are expecting for risking their capital into the business.
Okay. So you're saying it's the cost of debt and the cost of equity?
Yes.
Okay. But like, so why don't I just why don't I just calculate cost of debt and cost of equity? And like, what's the significance of a WACC?
Because they're not the same. So you have to put those two together to see what percentage both of them make up in the capital structure of the company. And since debt is more senior than equity, they're not the same percentages when you discount them back. So you have to put those two together.
Okay, so I would say this slightly differently, which is like I would say the WACC is like conceptually it's the your weighted average cost of capital,
Mhm.
average based on how much debt versus equity
Everybody has.
you have, right? Because the way you said it is like it's the cost of debt and cost of equity. I'm like, okay, but like yes, those are the components. But then like, so what, right?
Yeah.
So it's the overall cost of capital for the company
Mhm.
using a weighted average based on its capital structure. Like if you have a lot more equity than debt, then it's going to be weighted a lot more closer to the cost of equity, and vice versa, right? If you're using a lot of debt, then it'll be weighted a lot more closer to your cost of debt.
Mhm.
Does that make sense?
Yeah.
Okay, so let's say like if a company starts like taking on more debt, would their cost of capital go, or would their weighted average cost of capital go up or go down?
So, for example, because debt is more senior, for example, that would make cost of equity go up. But, and since you, so that would make cost of equity go up since it's riskier for equity investors. But since if you take on more debt, that would make the company riskier. That would make the company riskier because if something went down and the company went under, all the debt holders would get paid back first. So equity holders would get paid back less. So cost of equity would go up.
But like, I'm asking like, what happens to the overall WACC when you take on more debt?
Overall WACC
Yeah,
would,
because like you said, the WACC is based on like a weighted average
mhm,
of the cost of debt and the cost of equity, right? Like if you take on more debt, then you would weigh more towards the cost of debt and less towards
yeah,
the cost of equity.
right,
But cost of debt is higher or lower than cost of equity?
higher,
Cost of debt is higher than cost of equity?
yes. Is
Why?
it not? Because cost of equity is
What's
cost of
what's riskier if you invest in a company's debt or if you invest in their equity? As the investor, as the person giving the money to the company.
the investor.
Right, as the investor, I'm saying if you're the investor and you're giving the company your money,
Yeah, equity is more risky,
equity is more risky. Why?
right? Because debt is more senior, so you're the last one to get paid
Okay.
if
So
anything
as
goes
an
wrong.
investor, if you're taking on more risk,
Yeah,
would you expect higher returns or lower returns from this investment?
you would expect higher returns because it's riskier.
Yeah, like if you put money in a savings
Yeah.
account versus if you buy Bitcoin, like
Mhm.
which one do you expect to give you higher returns?
Bitcoin,
Yeah, but which one's riskier?
Bitcoin.
Right? It's the same.
Mhm.
I was like, that is like a fundamental law in finance that like if you take on more risk, you're gonna want to be compensated for that risk in the form of higher returns, right? Like no one will take more risk if it doesn't come with higher returns. And the same issue, like if you're taking on less risk, then you should expect lower returns. And if there's ever like an investment that has higher risk but lower returns, then no one would invest in it. And if there's ever a investment with lower risk and higher returns, then everyone would invest in it. And then like the market will just correct itself in theory, because if everyone's piling into the same investment, then like the return is going to go down.
Mhm. Right.
So coming back to this question though,
Okay.
we just established that cost of debt is lower than cost of equity, right?
Yes.
Because it's less risky.
Yeah.
You're getting paid back first.
Right.
You're willing to take a lower return.
Right.
If the company takes on more debt,
Mhm.
and now we're weighing the overall cost of capital more
Mhm.
towards the cost of debt,
Mhm.
what does that do to the WACC?
So WACC would increase. Wouldn't it? Because it's riskier. Now you have more equity. Now it's cost of equity went up more, which is riskier.
You're taking on more debt. You're taking on more debt, so that means that maybe we should use some real numbers, right? Like, let's say the company started with $50 of debt and $50 of equity.
Mhm.
Like 50-50 down the middle, right? And then let's say like the cost of debt is, I don't know, I'm use easy numbers, like it's 5%.
Mhm.
And then the cost of equity, let's say, is like 20%. Okay. That means the weighted average, but we'll forget taxes for a second, because also like there's a tax.
That's what I was thinking. Wouldn't that? Okay. Sorry.
Well, there's also a tax shield on the debt, right, which makes it even cheaper. But
Mhm.
even if we remove that for a second, we just said cost of debt is 5%, cost of equity is 20%. That
Mhm.
means that the weighted average cost of capital, if it's a weighting of 50-50, is what? How would you do
Um,
the mental math?
So 50 times 20%.
Mm-hmm.
And then, so 50 times 20%. And then what was the other one?
5%.
And then 5% times, what was the return for the debt, the cost of debt?
5% is the cost of debt.
Okay. So, okay. So 5% times the 50%. So you would get 10. Wait, 5 for debt. And then for equity, it would be 50 times 20%. So it would be 10. So equity would be 10 and debt would be 5
So you got 50%
times 20%.
times 20% interest,
Mm-hmm.
right? This
So
is
that's 10.
equity. And then for debt, you have what? Another
50% times 5%.
times 5. Okay.
Mm-hmm.
So what's each of these? This equals
10.
10%, right?
Mm-hmm.
And what's the other one?
5.
50% of 5% is 5.
No.
50% of 5% is,
2.5.
what is it?
2.5.
Yeah, you gotta be more confident. I mean, it's
Yeah.
half of something is just divided by 2,
Yeah.
right?
Oh, yeah. I don't know why. Yeah, of course.
So what's the weighted average then?
So the weighted average would be 12.5.
Exactly. You're just adding this up, right? Because 50% plus 50% equals 100%, right? This is 100.
Yep.
This is 100% of the pie,
Yep.
right? So then 10% plus 2.5% equals 12.5%. Okay. So if we said their weighted average cost of capital started out at, and again, just to be 100% clear, we didn't take the tax rate into account here. Like if we said there's also a tax shield of 20%, then like this 5% really becomes 4%,
Yeah.
right? But we're not doing that, okay? Just for simplicity's sake, because I'm just trying to teach you the concept. So let's say if we say WACC is 12.5%, and now they're going to take on more debt, right? So they're going to take on more debt. So if they're going to take on, they have $50 of debt and $50 of equity before. Let's say they took on another $20 of debt, okay? Well, actually, do I want to use $20? Might be kind of hard numbers. What numbers do I want to use? Let's say they took on another, whatever, it doesn't matter. Let's say they took on another $50 of debt. Okay. So now if they took on another 50 here, that means there's actually 100 versus 50, right? There's $100 in debt versus 50 in equity. So actually now the weighting is what? It's 1/3 of the cap structure equity and 2/3 of the cap structure is debt.
Mm-hmm.
Right? You still with me?
Yep.
So essentially, this is like 33%, and this becomes like 67%, right? Or whatever, 66.7, right?
Mm-hmm.
And then now if you redo these calcs, 33% times 20%, right? You're getting like 6.7%.
Mm-hmm.
Okay. And then like down here at the bottom, you got 67% times 5%, you're getting what? 3.3%. Right?
Mm-hmm.
So then what's your weighted average cost of capital now?
10%.
Yeah, it's 10%. So did it go down or up?
Down.
Okay, so conceptually though, why did it go down? Because before, half of your cap structure was costing you 20% and the other half was costing you 5%. In this new format, 2/3 of your cap structure is at this lower rate and only 1/3 of your cap structure is at this higher rate. So like when you do the weighted average of those two things, it's going to pull down your overall average, right? Because more of your overall cost basis is on this like cheaper side now on the debt. Does that make sense?
Yeah.
So that's what weighted average means, right?
Yeah.
But it's kind of a trick question because that's not all. Like, if someone asks you, because you started to get into this, you started saying like, hey, if you take on more debt, then your cost of equity is going to go up.
Mhm.
You're saying like, hey, if this side went from 50 to 67%, then you're saying what you were saying is that this number should not stay constant at 20%. Like this should go up. This might go up to like 30% or whatever. And then like that will actually cause your overall WACC to go up then, right? And you're not incorrect in saying that, but essentially what's happening is it depends on how much more debt you're taking on. Because if I try to graph like the weighted average cost of capital, like if down here is down here is like the debt percentage. Okay. So like this is right side is more, left side is 0, right? And let's say this is 100%. And then on the y-axis, let's say I'm graphing like the actual WACC, right? What it's actually going to look like is initially, as your debt is going, initially you had 0 debt. When you have 0 debt, your cost of your overall cost is going to be the highest, right? Like in that previous example, let's pretend this was 20%. If we had 0 debt and we just had equity and our cost of equity we said was 20%, that means it's 100% at 20% and 0% at 5%, right? So we're starting at the high point, and then as we increase more debt, we're moving to the right, but also our overall WACC is going down because of what we just showed here, right? Because you are shifting more of your cap structure to the lower cost basis, which is then going to lower your overall WACC, right? We just showed that mathematically, right? Are you still with me?
Yep.
Until you get to an inflection point at some point down here where you take on too much debt to the point where now the company is distressed. Right. Now, like only when the company becomes distressed does the cost of equity start going up. Does that make sense?
Yeah.
Because if I'm Microsoft and I have like, I don't know how much cash I have, $200 billion of cash sitting there, and I take on an extra $100 million of debt, like, is my company distressed? No. Are my equity holders going to care? No, because I have $200 billion of cash in the bank. Like I can pay that off in like the blink of an eye. Right? But if I'm Microsoft, I have $200 billion of cash and I go out and I take on $100 billion of debt, like, okay, now people are getting like a little bit more nervous, right? Now I go take on another $100 billion of debt. Now I took out $200 billion of debt. It matches my stack of cash. Like, okay, now people are like, whoa, what the heck? Like, should I be worried? Right? Should I be worried that like Microsoft is going to default eventually? And now I go on and take on another $100 million. Like that's us moving like towards the right side, right? We're taking on more and more debt, right? But up until a certain point, which is this inflection point, like up until that point, your equity holders don't worry because you don't have that much debt yet. Like you start out with 0, and it's healthy to have some debt because as you take on more debt initially, you're actually lowering your overall cost of capital. Does that make sense?
Yeah.
So when you're staying on like this side of the chart, like it's all gravy. It's like great, like take on more debt. We don't have that much yet. Keep lowering the cost of capital, and then you hit this inflection point. You're like, okay, now we're at the point where like our debt load is like getting kind of higher. Like if you keep taking on more, people are gonna start getting nervous, and then you keep going. Now your WACC is gonna start going back up. Why is it going back up? Because of what you said earlier, which is that your cost of equity is now starting to go up. The more debt you take on, your cost of equity is going up. And your cost of equity, if your cost of equity is going up, and like the benefit that you're getting from, shifting more to like a lower cost capital. And by the way, also, as you take on debt, not only will your cost of equity go up, but your cost of debt will go up too. Because the newer debt that you're taking on is going to be more expensive.
Right.
Because like the people that are loaning you money, when they loan you money like over here, they're like, oh, you don't have any debt. Like, yeah, I'll give you a really good rate. And then like you take on a bit more debt, and then like whoever's loaning you debt here, like, oh, you already have some debt. Okay, but you're not that risky yet. I'm gonna charge you a little bit more than the last guy. And then like by the time you get over here, they're like, okay, and it's getting kind of really up there. And like also typically the newer debt that comes in is junior to the older debt. Because like the original debt holders are not going to let the newer debt that comes in to sit on top of them in the capital structure, right? Like they're not going to let you take on new debt and say like, oh, if shit hits the fan, this new guy's going to get paid back before I am. No effing, right? So the newer debt that's coming in is usually going to be next in line, and then next in line, and then next in line. But they're still ahead of the equity holders, right? But they're lower on the like the payout order, or like we call like they have lower preference, and so they can charge you a higher interest. So like your cost of debt initially started out at 5%. Then the next time you borrow, the guy's charging you 7%. Then the next time you borrow, they're charging you 10%. And then the next time they borrow, like the next guy's like, I'm going to charge you 15%. And now you're getting closer and closer to like what the cost of equity is, right? When you blend all this together, your new cost of debt might be like, I don't know, like 9% or something, right? So that's why like your cost of debt, like once you get on the right side here, taking on more debt stops helping you. Like it stops becoming a good thing. It's actually like, it's increasing both your cost of debt and it's increasing your cost of equity for the reason that you mentioned, because the more debt that there is, the riskier it becomes for the equity holders, right? And the more risk that they have to take on, the higher the returns they're going to demand, right? To compensate them for that risk. Does that make sense?
Yep.
Are you still following? Like if you're not, like you got to ask questions about this. This is like an important concept.
No, I understood.
Okay. So the trick question here is like, as you take on more debt, what happens to WACC? Like it's not a linear thing like this or a linear thing like this. The tricky thing is like, it goes like this, right? It's like a U shape where there's like an inflection point at the bottom. This point, by the way, is also known as your optimal capital structure. Right? There is like a certain amount of debt you can take on where it's like the sweet spot, and our WACC is like the lowest, is like the low point, because you want your WACC to be as low as possible.
Right.
Because the lower your WACC, what happens?
The less you discount the cash flows back by.
Which means what?
Which means a higher net enterprise value.
Yeah, a higher valuation. That's what every company wants, right? They want their stock price to be higher. The way to get your stock price to be higher is to have a lower. One of the ways is to have a lower WACC. Right? Does that make sense?
Yep.
So like this, like figuring out what this optimal capital structure is, like that's the $1 million question. Right? I mean, that's like, it's an art, not a science, right? Like nobody knows exactly what is like the perfect ideal point, but like that is also partially what like the investment banker's job is to like advise their clients on like, hey, looking at your current balance sheet, looking at your capital, like, we can optimize your cost of capital. Like you have room to take on more debt. You don't have any debt right now. Or like saying, hey, dude, like you have too much debt. Well, not dude, like, hey, Mr. CFO, you have too much debt. Like we got to like, you know, probably like restructure it so that, you know, we can lower your cost of capital or whatever. Like this is part of the job. Right?
Yeah. Yeah.
Cool. Okay. Let's do a couple more. How you doing on time?
I'm fine.
Okay. So let's see here. Let me check the time. Okay, almost 7. I'm doing that with my wife after this, so I do have a hard stop.
No worries.
I don't want to make the wife angry. But okay, so let's talk M&A real quick. Like, explain to me like what accretion dilution means.
So accretion dilution is a way to see it's so normally when two companies, one acquires another one or two companies merge, they often look at the shareholders. Often they're the investors, so you want to keep them happy. So it's important to look at the EPS of a standalone business to the pro forma business. So accretion and dilution compares whether the standalone EPS was higher or lower than the pro forma. And normally, if the seller's net income plus the synergies is greater than the cost of the deal, then you would say it would be an accretive deal. And if it's the other way around, then it would be dilutive.
Okay, so if it's an accretive deal, then you're saying the standalone EPS is what?
If it's an accretive deal, then the standalone EPS was less than the pro forma EPS.
Okay, so the new company, the new combined company
Mhm.
will have a higher EPS than
Yes.
the original buyer.
Yes.
So let's say I'm looking at a deal, and I run the model and it says the deal is dilutive. Does that mean that I just don't do the deal then?
No, because accretion and dilution is something that's taken into consideration of the deal, but there's a lot more things that go into a deal. For example, if there's just better prospects in the future, like we said, like there's cost synergies or revenue synergies, there could be a lot more strategic reasons why the deal is going through. It's just keeping your shareholders happy and well is one of the big is something that you really take into account into a deal, but it's not the end all meet and all of if the deal goes through or not.
Okay. So let's say like the CFO is like, yeah, I really want to do this deal because I know this is going to be a great deal in the long run, but like I also need to appease my shareholders because I don't want to do a diluted deal and then like have our stock price get hammered, right? What are some of the things that you can like go back and redo the model? What are some of the things you can change in the model to like give the CFO what he wants?
So going back to the model, so the first thing that you do going through the model is you combine both of the company's income statements. So you go down line by line. And after that, so the first thing you have to do is find the how much you're going to pay for the deal. So after that, then you combine the income statements and you go down line by line. And then you make any adjustments for revenue synergies or cost synergies. So since that's something that's going to go more in the favor or of the EPS, you could increase cost synergies, for example. So you could cut down costs, or you could increase revenue synergies, which are less, you're less likely to predict what those are, as cost synergies are more direct. So then you get to operating income. And then based on how you paid for the deal, you paid either cash, debt, or with stock. So for example, if you want, since the cost of cash is normally less than the cost of debt, for example, you could finance the deal with more cash than debt. So that could make the deal more accretive and make it less costly. So you could take on more cash. So you would make any adjustments to interest income or interest expense. And then you would get to pre-tax income. You would apply the buyer's tax, and then you would get to net income. And then if you're taking on stock,
Why do you apply the buyer's tax?
because normally the other company goes, like the shares of the other company go away. Why do you apply the buyer's tax? Because the other company doesn't remain. It's the buyer's company becomes kind of the main company, the parent company. So the other company doesn't really exist anymore.
Okay.
So then you get to net income, and then you divide that by the amount of shares. So if you also issued stock, stock is essentially the most expensive cost of equity, cost of stock. So if, for example, if you wanted a more accretive deal, you would pay more with either cash or debt than with stock. So you could, for example, do an all cash deal, which from the seller's perspective, it would be an all cash deal, but for the buyer, it would be cash or debt. So you could do that instead of issuing stock. and then also you could do more cash than debt. That would also make the deal more accretive. So those would be ways. That's really messy.
Yeah. So I kind of let you finish your answer because like you basically start walking through like step by step how the accretion dilution model works.
Yeah.
I just want to see like if you understood it, and I think like it seems like you do. But like as far as answering this question, essentially what I'm asking is like, what are the drivers or what are the levers you can pull
Mm-hmm.
model to just like make this model more accretive? Right now, it's good. You want to
Okay.
make it accretive. What can you do? Right. But I kind of like asked it in a way that was a bit more disguised, right? Like
Yeah.
the CFO says this and blah blah blah. That's all noise. Like
Mhm.
you just like listen for like what are they really asking? Like I'm asking like how do you make a deal more accretive? Right?
Okay.
That's what I'm asking. And like
Okay.
the answer to that is like it can be very succinct. It's just like, yeah, one, it's how much you're paying for the deal, right? Like if you pay a lower price, it's going to be more accretive, right? Because accretion dilution, the way to think about it is just like another way of measuring like what is the return on this investment for the buyer.
Mm-hmm.
Going back to what we said earlier, like you pay a higher price, same thing in LBO, right? You pay a higher price, you get a lower return. You pay a lower price, you get a higher return, right? In this case, like you pay a higher price, it's more dilutive. You pay a lower price, it's more accretive. So one is how much are you paying?
Mm-hmm.
Two, how much or how are you paying? Let's say like this deal is going to cost $100 million. You can, like to your point, to what you said earlier, you can pay $100 million in all cash. You can pay in all debt. You can pay in all stock. You can pay like a mix of all three, or a mix of two and not the other one. Like whatever. There's a lot of different ways for you to like put $100 million together.
Yeah.
And then you're just like doing what? Taking the weighted average cost across all three, which is very similar to kind of like the WACC concept, but like I mean a different context, obviously, right?
Yeah.
Like if I'm using out of the $100 million, if I'm paying $50 million in cash, and then like $30 million in debt and $20 million in equity, then like the cost of capital is going to be, you know, 50% weighted towards the cost of cash, which is the lowest, 30% weighted towards the cost of debt, which is the middle, and then like 20% weighted towards the cost of equity, which is the most expensive.
Mm-hmm.
But if the cost of doing the transaction is lower because you use cheaper form of capital, like you use more cash and less equity, then it's going to be more accretive, right? And if the cost of doing the deal is more expensive, then it's going to be more dilutive, right?
Mm-hmm.
So first thing, again, how much are you paying? Second thing is like, how are you paying for the thing?
Yeah.
And then the last thing is like, what are you getting for what you pay?
Yeah.
Right?
Yeah.
What are you getting is like, how much earnings is the target company actually bringing over? How much earnings are they contributing to the combined company?
Mm-hmm.
And that includes the effects of any synergies that you would get from the deal.
Okay.
Right? So synergies can be lumped into that third category, but like, because how much you're getting, like, it's not just synergies. You can also make more aggressive assumptions about what the target company is going to do on a standalone basis.
Mm-hmm.
It's the same thing that I said earlier. Is like buy side and sell side, buyer and seller, they're going to have different opinions.
Mm-hmm.
When there's M&A deals happening, the seller is going to be like, look at our numbers, they're great. We're going to do amazing. We're going to grow so fast. Our margins are going to be so good. This is why you should pay us more.
Mm-hmm.
And then the buyer usually be like, no, that's BS. Like, it's not going to grow this fast. This margins look like they're going to try to like push the price down.
Yeah.
But like if they really want to like paint a better picture of what this deal will look like, they can just like rationalize like, oh no, actually the revenue is going to grow faster. Like, oh, like actually the margin is going to be better, or like whatever, right? Then that means that the earnings that they're contributing is going to be higher, right?
Yeah.
And then you add that on top with like the synergies. So that was a standalone. The standalone rows are going to be higher. That's one way to do it. And then the synergies is another way to like juice the numbers.
Mm-hmm.
Synergies is just like, sometimes it's just like,
Yeah.
yes, math, like you can make up whatever synergies you want, right? I can say if I take on my competitor, I can increase my prices 20%.
Mm-hmm.
Who knows if you actually can? You could increase prices 20%, but people might stop buying your stuff. Like, how do you take that into account? Right? What's the price elasticity of your product? Like, so that's why, like, I think cost synergies is a lot more real
Yep.
Because you can literally say, I'm going to fire this person, this person, this person, this person. I know exactly how much we're paying them. So that's how much money we're going to save. I'm going to shut down this office so we no longer have to pay rent. Like that's like very concrete stuff versus like the revenue synergy stuff is just like sometimes just like woo math, right? And just like, but in this case, if the CFO says, hey, we want to show like a better picture,
Mm-hmm.
that would be an easy place to go. Right? It's like let's put more revenue synergies in there or whatever.
Right.
It
Right.
might materialize though, right? Like 2 years from now, when it doesn't materialize and your investors are expecting that revenue synergies, like then your stock will get punished. But at least you're kicking that can down the road, right?
Yeah. Could you say like cost synergies? Like, could you say we could just cut down a lot more costs? You could, no? That would make it more accretive.
You could also say, yeah, we can cut down a lot more costs. Yeah, you
Mhm.
can, right? But like, to somewhere like this answer can be very concise. Just like, yeah, the three drivers are how much you pay, how you pay for it, meaning like cash versus debt versus stock. It's different cost of capital. And then like, how much are you getting for what you pay, which is like, how much does the target company do on a standalone basis? And also like, are there any synergies that you're taking into account? So like, that's it, right? That's like a 10-second answer.
Yeah.
And then like, if they want to like elaborate on any of those things, they can ask you follow-up questions like, well, what do you mean by the synergy? Like, tell me about that. And then you
Yeah.
can give them a more thorough answer just on the synergy piece or just on the cost of capital piece. Like, oh, what do you mean by like, how you pay? Like, what does that mean? Right.
Yeah.
But you can like save that for them to ask you more questions before you give it.
Yeah.
Make sense?
Yeah. Makes sense.
Cool. So yeah, I mean, I would say like overall, like, I think there's more work to be done, right? I think it's fair to say that.
No, for sure.
I think you've definitely made a lot of progress since like when you first started, but I think there's still like holes that we need to kind of patch and just like things you need to know better.
Yep.
You've gone through all the modules at this point, right?
Yep.
Yeah. So I think like some of these is like for the parts that you don't know as well, going back and like rewatching certain parts of the modules, second time, third time is like you'll pick up new things. And then some of it is like it's like doing more practice questions for the areas that you don't feel like you're as strong in and like seeing how well you're answering those questions.
Yeah.
And if you aren't able to answer them as well as you would like, obviously like there's always an answer key, like whether you're using like some of these guides or like if you're using like the mock interviews at the end of the module, like the answer keys, like me recording how I've answered these questions. But like if your answers aren't close to what's like in the answer key, then like that's when you start thinking about what am I not doing and like start asking questions. Right?
Yeah. Makes sense. Makes sense. I think two of the big things. So yeah, well, the main thing I think is also sometimes in the answers, I think you do this also to give multiple examples for those listening. But I think sometimes I was going to ask you that if we're supposed to go so much into the answer where like, I feel like you go both ways. You want to prove that you know the content, but you don't want to like over like give, So sometimes like I know like for example, if they ask you besides like the 3 valuation methodologies, what are other ways? Like, I don't know, you could go on forever about that. So like, I guess like 2 or 3 examples is good enough. Or like, there was one question that was like, how do you calculate? So like, the fully diluted share count. So you would have like basic share count and fully diluted, but then you also like went into talking about like the treasury stock method and with stock options and everything. So like, for example, for something like that, if it's like calculate how would you get the fully diluted share count? Would you just say like the basic share count and the dilutive securities, or would you go into like there's stock options and warrants and then like go through the whole treasury stock method, or is that unnecessary?
It's a balance, right? Like for that question, I would say like, yeah, you take the basic share count and then you want to include the impact of all the diluted securities, such as stock options and restricted stock units and warrants and convertible debt. And I would just leave it at that.
Okay.
The minimum you said is like basic shares plus all the diluted securities, and you don't say what they are. That's like, I would say that's probably like too brief, right?
Okay.
Getting into the weeds and like, oh, this is how you do treasury stock method and this and that and blah, 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 blah. Like that's probably too much, right? And so the middle is like, I tell them, yeah, basic plus diluted securities, which can include A, B, C, and D.
Yep.
And now they can ask you a follow-up question. Okay, so talk to me about like how would you calculate the dilution from stock options? Okay, now you go into treasury stock method, right? Because like when in doubt, by the way, like if you're not sure how to strike that, like how to strike the right balance, then I would say like just err on the side of being more concise and more brief. And they reserve the right to ask you more follow-up questions anyway. Like they're not going to be shy about like drilling down further if they're not satisfied. But if you like err on the other side of like giving them everything you know, and they are like, oh, it's not what I asked, right? For example, when I asked you like, what are the drivers of accretion dilution, and you start going to like step by step how it works, that's an example that's like, that's not what I was getting at. I just wanted to hear like those three things.
Yeah.
And then so that's like giving me too much. And then like sometimes like when you do that, you're gonna lose their attention.
Yeah. Yeah. Yeah.
So yeah, let them ask follow-up questions. Like the more follow-up questions they ask, like honestly, the better it makes you look, assuming you still know the answers to the follow-up questions.
Yeah.
Does that make sense?
Yeah, for sure.
Cool. Any other questions?
No, not really.
Okay.
Not really.
All right. Well, keep working on it. We still have a bit of times before. I mean, I think it's getting closer and closer for sure, but there's still more time before most of these interviews start up. So, you still have time to kind of perfect everything.
Yeah. Okay. Sounds good. Yeah. This is definitely my main task right now.
Okay.
Okay.
Awesome. All right, Ximena, I got to run, but this was a good session. And let me know if you have any questions, and keep me posted on all your progress.
Okay.
All right. I'll talk to you next week.
Thank you, Sam.
Bye.
Bye.
Thank you for tuning in. If you enjoyed the content, please subscribe to our channel or podcast so that you can get notified of all of our future episodes as well. If you'd like to apply to work with us so that we can help you in a similar way, feel free to reach out to our team at www.wallstreetmastermind.com/apply. The street is abbreviated to ST, so it's wallstmastermind.com/apply. Talk soon.